Hello, everybody. So today we had the FOMC meeting, the Federal Open Markets Committee. They meet 8 times a year. They're going to meet this month, which they met today. They're going to meet next month. They're going to skip August. They're going to do September, skip October, and then they have November and December. What exactly does the FOMC do? What are they responsible for? They're responsible for maximum employment and stabilizing the economy. Remember the word. Maximum employment. What exactly does it mean to stabilize the economy? It means to have a federal fund rate that is neutral. The federal fund rate is the interest rate that the Federal Reserve gives to the prime banks. Those are the biggest banks in the country. Those prime banks then give something called prime plus to smaller banks, and this affects all borrowing and lending within the United States. This affects your school loans, your credit card bills, your financing, your leasing, your home equity lines of credit, your mortgages, your regular lines of credit, so on and so forth. Over the last year plus during coronavirus, the federal funds rate was near zero to 0.25. As of before this meeting, the federal funds rate was at 1%, which means we 4x'd the federal fund rate. And this is one of the most aggressive federal fund rate that the Federal Reserve has done. Even more so, they raised the federal fund rates by 50 basis points last meeting. That is also in and amongst itself one of the most aggressive movements they have made in history. And today they raised the federal funds rate by 75 basis points, which is the highest federal fund rate hike since 1994, nearly 30 years. It's absolutely insane if you think about it. It's also absolutely necessary to try to calm down the inflation rate that we have today. The CPI data came out and the inflation rate we have in the country is 8.6%. 8.6% is following 8.3% the month before, which was reduced from 8.5% the month before that. A lot of people had high hopes that inflation might have reached an inflection point and started coming down. Unfortunately, this was not the case on Friday. Because inflation keeps going up, that means that the Fed needed to be a lot more aggressive than they said they were going to be. It was understood that we were going to get 50 basis points hike today, 50 basis points next meeting, and probably 50 basis points the meeting after that. Well, everything turned around with this new CPI data. We got 75 basis points this meeting. We're probably going to get 75 basis points next meeting. And the meeting after that, we're probably going to cool down to 50, depending on what's going to happen with the economy. How exactly does this federal funds rate affect inflation? The cheaper it is to borrow money, which means that the interest rate is lower, the easier people borrow, the easier somebody borrows, it says easy come, easy go. So you spend money as quickly as you get the money. However, if you raise the interest rate and it costs more money, it's more difficult to get money, you don't spend as much because you actually feel it. You've ever been in a casino? Did you ever gamble with those magic chips? It's one of the biggest magic tricks the casino ever pulled. Because you use these little chips instead of actual dollars, you're more prone to throw them into the pot. Have you ever actually gambled with real hardcore money? You're not as prone to throw a stack of $10,000 as you are to throw one chip representing $10,000. Well, this is sort of the same exact situation. The Federal Reserve says that they want to bring the federal funds rate to 3.4% by the end of this year, 3.8% by 2023, and 3.4% by 2024. If the current federal funds rate is 1.75% and they want to bring it to 3.4% by the end of the year, that means that we have a shortage of 1.65%. And since we have 4 more meetings, we need to divide 1.65 by 4, so we get approximately 0.4 something basis points per meeting, which means in one of those meetings, we should have a 75 basis rate hike and we should have a 25 basis rate hike. But then again, take this all with a grain of salt, because last meeting they said 75 basis points was off the table. They change their narrative as they see fit during the economy and whatever is happening in our economy at a particular given time. With that said, to give you some more data, they want to bring the inflation down to 5.4% at the end of this year, 2.6% by the end of 2023, and 2.2% at the end of 2024. As the Federal Reserve is able to bring down inflation, then they can go to that federal fund rate neutral rate. And the perceived neutral rate is somewhere between 2 and 2.5%. But that doesn't take into effect the maximum inflation that we have right now that is absolutely insane and devastating our economy. Earlier in this video, I told you, keep in mind the two mandates of the Federal Reserve: maximum employment and stabilization of the economy. Why do they keep saying maximum employment? As aggressive as they are, the economy needs to be able to eat that aggression. How do you eat the aggression of higher interest rates? You need to have a strong jobs market. People have to be working. Currently, our jobs unemployment rate is 3.7%, and they want to bring that to a healthy 4.1% by the end of 2024. Question is this interest rate hikes actually going to do anything against inflation? And the answer is no. It is a perceived number. It is an illusionary number. This number that they're raising the federal fund rates, they actually need to be raising it by 1.5 times the actual inflation, in my personal opinion. So the stated inflation is 8.6%, so they need to be raising it by 12 or 13%. The problem is, and I've said this many times before, we have over a $30 trillion debt in the United States. For every 1% that we raise that federal funds rate, we need to pay $300 billion in debt payments. We will bankrupt our own country if we raise the federal funds rate to 12 or 13%. Which leads us to the question, Adam, what the heck are we going to do? How are we going to bring down inflation? The way they're going to do this, and if you listen to the federal meeting today, if you listen to what Jerome Powell was saying, and I was texting it during my live earlier today, they're going to wait for unemployment. That's right, as crazy as it sounds. One of the surefire ways to slow down the economy and bring it to a halt is to have more unemployment. I know it sounds crazy and it's counterintuitive what I'm saying, but as long as people are working, that means that there's money coming in. If there's money coming in, you have money to spend. If you really want to stop the economy and reduce the inflation because people are going to be spending less, you need to reduce the employment. If you listen to the meeting today, I mentioned it many times, Jerome Powell kept saying, yeah, people losing jobs, so on and so forth. He can't straight up say, listen, we want people to lose jobs. He can't say that. But he did say, and I quote, we cannot have price stability with this labor market. Jerome Powell was probably going to get his wish. Coinbase reducing employment by 18%, Gemini by 10%, Robinhood by 9%, Target, Walgreens also are going to lay off a lot of workers. There's going to be tons of layoffs. Interestingly enough, Palantir is not laying off workers, they are hiring workers. But Elon Musk and Tesla definitely reducing workforce by 10%, which is going to be approximately 10,000 jobs. But not the factory workers working their butts off every single day in and day out. The people that are lazy at home doing nothing. Unfortunately, what's good for the economy is not necessarily good for the stock market and vice versa. The entire market reacted really positive by raising the interest rates by 75 basis points, which is counterintuitive of what we thought would happen. Honestly, I thought at 75 basis points, the market was going to react negatively and it would go down because we were expecting 50 basis points. Maybe because they were leaking 75 basis points over the weekend and the last couple of days, maybe that softened the blow and we kind of priced it in with what happened in the beginning of this week. But the entire stock market and the entire crypto market did prop up. And there's a very interesting chart that I saw as I was waiting for the live earlier today. They were showing that not in this recession, which we are right now, but in the last 3 recessions, as there's a recession, the interest rate is actually going down, not up. If we have a recession in this quarter, which I believe we do, this would be the first recession where interest rates is going up that I noticed, which is very, very interesting. It's a very big predicament. It's a very interesting and sticky predicament that we have right now. If we increase interest rates and inflation does not go down, and we have a recession, which means negative GDP, we're not growing, high inflation, and negative GDP equals something worse than a recession called stagflation. And a prolonged time of stagflation can lead to a major depression. Do I think this is going to happen to our economy? No, we are going to figure it out eventually. Eventually, people are going to lose their jobs. Eventually, people will stop spending as much money. Eventually, the war in Ukraine will stop. Eventually, gas prices will go down. If we can reduce at least one thing like the gas, like the energy, I believe a lot of other sectors are going to go down as well. A lot of people are charging more money for a lot of produce and a lot of services and a lot of products because of the gas prices. They're just too high. If we can reduce the gas prices, that means the overall cost for a lot of things in our economy will also go down. And if that happens, the overall inflation might just go down. Also, if somehow, some way the Ukrainian war is going to stop, which I don't see it happening, but if it does, well, then inflation is going to severely drop as well. So we have a lot of indicators that might catch up to what's happening in inflation, and this might bring down the inflation and our economy might just be back on track. In terms of the stock market, in terms of the crypto market, and in terms of the real estate market, nobody knows what's going to happen. And even if you think you know what's going to happen and you follow what happened in the past, does not necessarily mean it's going to happen today and doesn't necessarily mean it's going to happen in the future from now. The best thing you can do is collect a lot of data and try to figure out what's going to happen. I'm going to tell you again and again, at this particular point in time, on this stage of the game, we did get a huge rundown. We are in a bear market, nearly a market collapse. However, it is possible that we're going to go a lot more if you look into the past. That doesn't mean that that's going to happen now. So try to go with your gut. Try to invest into projects and companies that you have maximum conviction for. Drop the companies that you don't really believe into. And if you can't tell me why you're invested in a project, whether it's crypto, whether it's real estate, whether it's precious metal, or any stocks, then you should not be invested in that company because you have zero conviction. And when I say that, I mean that in the truest possible form. Sit down, go look in a mirror and say, hey, why the heck am I invested in this company? And if you cannot answer that question, there's a freaking problem and you might want to do more research. I'm not a financial advisor. This is purely entertainment and educational purposes only. I'm going to be here in exactly a month doing a live on this exact same thing. Today, the market blessed us with a little bit of a bull run. Let's pray tomorrow might be a good day as well. Thank you.